Good morning, everyone. I'm Martha Stokes. I'm a chartered market technician, and in my retirement, I love to educate people. TradingView has a great charting system and a great potential for all of you to make a lot more money in the market. I want you to think about raising your expectations. You have far lower expectations than you should have. You should have a very high expectation. It may take you a while to learn all the ins and outs of the intermarket structure, which is what I focus on. You can learn about indicators, and you can learn about candlesticks, and you can learn about other things from other educators on the TradingView format, the wizards. But most of them don't have the inside view, the market structural analysis and knowledge that I have. So I like to share with you something that is uniquely different that you can learn from. What I want to talk about today is the concept that we have a .ai or an AI bubble. That is totally false. Yes, there are problems with AI. Yes, it is being used far too soon in the financial markets, which are very, very sensitive to new technology. And if it's used wrongly and accidentally, improperly, we'll have a flash crash like we did in April. We had a big flash crash. And it's basically what happens is there's a intermediate or short-term downtrend. This was a short-term downtrend. This was a correction over here, a short-term correction, and then it moves back up, and then it goes sideways, and then it corrects a little bit on earnings were a little weaker in some areas, and so on and so forth. But it should have ended right here, right there, and it did not. We had some fear and panic. First, it was fear, and fear is the shock. And everybody stops and they go, oh, something's wrong with the market. Look at how it collapsed that day. Boo, it just went way, way down. And they stop and they're shocked. So what happens is a void of buyers. There are no buyers. So the HFTs sell short. Hedge funds sell short. Sell side institutions on the floors of the banks sell short. So we have this trickling coming down. It's coming down. We have a gap, shock, total shock right here. Then we have the next day, we have this huge gap because suddenly people are saying, oh my gosh, I've got to get out of my stocks. I've got to sell. This is retail side. And they do this all the time because they don't understand the market structure. They don't understand that the market depends upon fundamentals. You are studying technical analysis, but you are actually studying fundamentals in a stock chart format. This is called spatial pattern recognition skills. We have a correction here. We have a slow move up with some accumulation going on. We can see that rising. Now stocks start to get a little bit, tiny bit speculative. And so it corrects because that earnings was not, many of the earnings were a little bit weaker than what was expected. And it moves up and it should have ended about here or at least down here. But it didn't because we had a sudden shock and fear that the markets were going to go down because of a non-event. The non-event was the information that the government was going to start having tariffs on every country in the world. It was a threat. It wasn't an actual event. Actually, the next day or so, it was set aside to negotiate with the countries of the world. So it was a non-event, and non-events often cause flash crashes, especially with HFT AI and hedge fund AI, smaller funds using AI, and none of them are being cautious enough because this is a new technology and AI makes mistakes. It forgets and misinterprets. It doesn't understand. It chooses the wrong data set. It overanalyzes the wrong data set. It can't find the data set, and so it just makes up something. And that happens a lot. This is it's okay in the real world. You can get frustrated with your AI and say, oh, I don't, I'm mad at it because it's doing this or it's being stupid or it forgot this or it forgot that. But in the financial world, it is dangerous. And every flash crash that has ever occurred in the market, and there are many of them, happened because an AI or other new technology was misused and caused a flash crash because of the human error of misusing or using a new technology before it was ready, regulated, analyzed, rewritten, redone until it was really optimal for using in the financial markets. Everybody's rushing to use it in the financial markets, and it is way, way too soon. It has a lot of growth in it. We are not in a bubble. If we were in a bubble, this would be going up spectacularly, way above, at a vertical angle of ascent or near 90-degree angle of ascent. What we have is we have a market that corrected quickly out of the flash crash. Flash crashes are flash crashes. They are the speed, the technology, the breadth, the systemic action of it is what makes it a flash crash. It is completely different because the buy-side institutions will move in as soon as fundamentals are above or below price. As soon as fundamentals, the price falls into below the fundamental value of the index, the ETF, the stock, whatever, they will come in and buy at bargain prices and push it up. This is the only time that buy-side institutions will show a long candle. So we have a very long candle. Then we have some minor selling days that is also met with buy-side institutions buying and moving it up. And then it returns right to where it was before and continues trending up. We do not have, we have a sideways trend that is getting wider, and it may get deeper. There's some risk of another flash crash because there's a lot of fear mongering. There's a lot of non-events that are being stipulated, just like the AI bubble. Oh, we're having an AI bubble. Everybody sell, everybody sell. Well, then first thing that's going to happen, if it happens, is that investors and people who don't know anything about the market, you know a lot about the market, but you just need to know more, will panic and either move funds around in their 401k or their IRA, or they'll sell or whatever. And so the HFT AI will go, oh, I've got to gap this down hugely. So it does. And that starts the flash crash. So we have to be careful and be knowledgeable and know that some things are true and many things in the news are just entertainment or intended to scare or intended to drive stocks down rather than drive stocks up. This is a common problem, and AI exacerbates that hugely. So we have a widening sideways pattern. It's not a trading range pattern yet. And if it holds and supports here, it's a very weak pattern. We're heading into a long, long weekend, holiday weekend for U.S. citizens, and Thanksgiving Day, Thursday, and Friday, there's a half a day. I always recommend that. That's too illiquid to trade, but be very careful if you think you can. And then you will have Monday. And Monday is the day that is most common to have big gaps and big down days, because people have had time to think about it. They've had time to check their stocks, their 401ks and everything, and they make a decision. All of a sudden, we have all these sell orders. So then the sell short banks are selling short to make the market, and then they will cause a huge gap down or rundown. Usually it's a rundown because what they're doing is they're setting their buy to cover really super low, way, way low, but also at a fundamental level. So they won't go beyond that fundamental level. Why? Because the buy-side institutions will come in and they'll lose all their profits on their sell short. We have a war between the buy side and the sell side. It's been going on since 2008. And nobody knows about it. And it matters. It matters that you have this information so that on Monday you can be prepared, because the sell short will be buy covers as soon as it hits the fundamental values. And we're going to be hitting the fundamental values somewhere in here, unless the HFTs can drive it down even further. And then it'll take another day or two before the buy side institutions drive price up. They'll wait for that to hit the fundamental level. If it doesn't, it'll hit the neckline of the flash crash. The neckline is a very strong support level. So there you have it. I hope you have a wonderful Thanksgiving if you live in the US. If you don't, I hope you have a wonderful few days off. Take some time and study things and review and learn, because you have a lot to learn that is about the inner workings of the market and how it reacts to retail and small funds managers and what to do about that. I'm Martha Stokes, and that's the topic for today.